I'm managing 7 relationships with people
Yep.
that don't know each other, raising money from all of them, trying to make sure that the first person that put money in isn't screwed by the last person who doesn't put money in, closing the deal, qualifying for the debt, and then managing it for 20% of the deal.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I am Dustin Bailey, and I'm here with a very happy-looking Adam Penn. Hello, Adam.
Well, I was told I don't
How are
smile
you?
enough to get the headshot, so I figured if I just stood still for 10 seconds at the beginning with a smile, I would get a good headshot.
Yeah, it's the only time during the episode you're
It's the
actually smiling.
mustache. The mustache makes it look like a frown, but
Yeah,
it's actually a smile. Maybe if I did the fireman, like curl up
that
the
might
head.
help. But I also think you just naturally have a dour disposition. I think that's
That was
word.
a PC friendly version of that.
Yeah, maybe slightly. Yeah, we have gotten. I will say we've gotten some listener feedback on your enthusiasm. So you got to make sure to be smiley and peppy and
So
all that stuff.
if I know my girlfriend didn't say that, and the only other listener we have is your girlfriend. So Mercy, or your wife.
My
So
wife.
Mercy doesn't think that I smile enough.
We have more people than just that. We used to make that joke, and this podcast is growing. We were Adam and I were talking about that actually before we jumped on here. It's nice to see that. So thank you to everyone for going out and doing the things that we ask and let the computers know and all the like and subscribe and all that fun stuff. We really appreciate it.
We do.
We do, absolutely. Well, we have a fun topic we want to talk about today, don't we, Adam?
Yep. You want me to dive into it?
We can actually, because this was I think this originated from maybe some some direct conversations that you've had, but I've also heard it just generally before. So you can kick us off.
Yeah, so I think that the idea is that I've had conversations with friends or colleagues, investors, family members, and talking about the deals we do. And maybe they're real estate investors or they invest in their own portfolio through the stock market or whatever, right? They're not just W-2s looking to invest. Nothing wrong with that, but these people have done deals in their own pocket. They know how to manage them. They know how to do them. It's always funny. We've talked about this a lot, right? You'll show someone the returns, you'll show them the tax benefits, the projections, the building, and they love all of it. And you say, okay, well, this is how we do it. This is, we're forming an LLC, we're buying it. There's a 1% origination fee, and then we do an 80-20 split. And they say, well, what's an 80-20 split? And you say, well, when there's net profit, we take a promote. That's what's normally referred to as a promote. If we make $10,000 net profit in a quarter, 80% goes to the limited partners and 20% goes to the sponsor as for running the whole thing, right? I mean, there's other fees that we get for running them, kind of the admin side of things, but this is our carried interest, right, for pulling the whole thing together. And then they'll blow up and they're like, well, I'm not going to give you 20% of the deal. And you're like, well, you just liked the returns that we talked about and you just liked the deal. I'm not saying I'm taking 20% out of those numbers. Like that was already all factored in, and then they don't like it.
The returns are net of all of those things. That's the end result to the 80%.
Mm-hmm.
Yeah.
So it's funny, right? Because then those same people, and I'm not sure of this, but the other day I was thinking about it. The first deal I ever did with a partner was 50-50. And that sounds way worse than 80-20 in my mindset. But it was, we went and we bought a building. I put down the down payment. So I wasn't even really an LP because I also did the work. And the partner qualified for the debt. Once again, I kind of did the work. So I think I did take the brunt of it. Not complaining. I was happy with the deal, right? I was able to get another building when I wasn't able to qualify for the debt. And we split it 50-50. And we still split it 50-50 to today. Now, there was a recoup of my initial capital, which is a little different than how we do it in a syndication. I did get my initial capital back, but that was targeted to happen within a year, which we did. And so we recoup our initial capital there, and we went 50-50. And I just think that I would have a hard time raising money for a deal if I said, hey, you're going to get all your money back, and then we're going to split it 50-50 right down the middle.
Yeah.
I don't think it's going to go well. Maybe that's just, maybe I should try it. Maybe it's how, we're going to make our next deal. But I don't know. So those are the thoughts that popped into my head.
We had an episode recently talking about waterfalls and deal structures, and I think this is a good continuation of that, because it is funny to me. Like there's and Adam, that first deal, was it a flip, or it was a smaller property,
a single
right?
family home, still on
Okay,
still 50-50.
And that's the thing that I feel like you get people that will play in that space and like, okay, you're going to put up the debt, I'll put up the money, or, vice versa, whatever. And it's like, we'll split it 50-50. And if it's for whatever reason, when it's this small apartment like that, nobody really blinks an eye. It's like, oh, okay, that's good. That makes sense. And yet, to your point, when you start talking about some of these syndication structures, and then you get the same investors who, if they were going to partner with somebody else on a single family home, would not really think a whole lot about splitting it 50-50. Now that the only thing they have to do is write a check, they're like, that's just, you can't take 20%. That's just way too much for me. And it's like, where's the disconnect?
Yeah.
And, I've seen it from that. I've also seen it from, and it's more common, and I can kind of understand this point of view from folks that have only done deals by themselves, right? And like you get folks that have just been serial house flippers. They've started out with not a lot of money. They use hard money debt. Then they use their own money to fund their deals. They don't really have like investors, so to speak, and they're not partnering with somebody else. I've heard them object to this, and they're like, well, I do all my real estate on my own. There's no way I'm going to give up 20% to somebody else. And it's like, okay, well, so I can see that side, and there's some legitimate arguments, but the side that just makes no sense to me.
If you brought them a deal that they had no access to, off market, and you said, I'm going to get the debt, you put the money up, they would probably be like, oh, yeah, 50-50 seems good. Because most of those people still have one partner in a deal or something.
Usually. Yeah. Yeah, no, there's some sort of weird mental thing that like once the deal, for whatever reason, starts getting larger, or like it's outside of that box that like everyone's like, okay, we're doing this small thing and we're splitting it 50-50. Like once it gets outside of that, then they're like reluctant to give up
20%.
Some manner of ownership.
Yeah. Well, it's funny too, because right when you get a bigger deal like that, I mean, even something small like a 20-unit building we have in town has 7 partners on it. Well, the 7 partners, it's somewhere between 5 and 8. So if someone's listening and said, then I said a different number of partners before, it's because I can never remember. But it's like around 7 partners. I'm managing 7 relationships with people that don't know each other, raising money from all of them, trying to make sure that the first person that put money in isn't screwed by the last person who doesn't put money in, closing the deal, qualifying for the debt, and then managing it for 20% of the deal.
Yeah.
Bigger deal.
Yeah, and that's the thing, going back to the people that would say, well, I'm always used to doing stuff myself, and it's like, totally fine. There's nothing wrong with that. But now also understand that for 20%, which is a relatively small slice, right? You now don't have to do any work. Like there's in a syndication as an LP, you're writing a check and that's it. And you're still going to get fairly decent returns, maybe not as much as if you're doing the work yourself, but then now you have to, that also completely discounts the value of your time, right? And that's saying, well, my time's worth nothing. So like you kind of have to do a little bit of math to get back into that. But I don't know. It's strange to me that for whatever reason, some people will look at this and say, well, there's no way I'm going to split. If I'm putting up all the money, I'm not going to split this with anybody else. It's like, well, you're not doing the work, for one. Like you're now going to get a benefit from someone else doing all the work, which is the literal definition of a security. But that aside, the other thing that's missed is the pie is larger, right? So it's not like you're giving up, even if you were used to doing small deals by yourself, you're not giving up this like 20% of a relatively small pie. It's 20% of this like massive pie. So your 80%, or the 80% that you're exposed to, is a much larger dollar amount, right? Like the economics of this typically tend to work out better simply because the pie is larger. And again, for whatever reason, you get people that will have just this mental block around wanting or not wanting to give that up. But then if you come to them and say, hey, you and I partner on something on this deal 50-50, they're like, okay, sounds good, let's go. And it's effectively the same like setup where either you're qualifying for the debt or putting down the money or doing most of the work or something like that. I don't know. It's interesting that like you, Adam, I've heard this in the past, and like when I've explained the syndication model to people that have only ever done single family investing, they're like, well, why would I ever do that? And then here you get people again, if that's what they're used to, they start hearing this idea of splitting this in some like non-equal way, and even though it's in their favor,
yeah,
and it still triggers all these things. Like, I'm not doing that. That's not fair.
it's I think the point is that when you're analyzing a deal, you need to analyze the deal, the work getting done, and the returns, and not weigh the other part of it, right? I mean, I don't. This is probably a bad example, but if Elon Musk is starting a new company and needs a loan to go start in, you're going to get 80% of the shares, and he's going to take 20% for doing it. I mean, how quickly are you going to go throw as much money as you want at him just because you trust what he's doing, right?
Yep.
So I think you've got to analyze the deal.
For sure. And that brings up a good point too, that even, to kind of go to some of the investor side, I think the better argument, the better objection to this would not so much be the split. Maybe the split is egregious, right? Like if it's truly 50-50 in a syndication, that's a little weird. But asking about the fees, right? And Adam, you touched on this early on. I mean, that I think is the bigger thing, that you should probably get more hung up on fees than the split, especially if the split's something that's fairly common, like 70-30, 80-20, 85-15.
And the fees /split seem to scale with the deal, right? So going back to the 50-50 side of things, right? If you're splitting a single family home 50-50, on that one I originally mentioned, I make about $1,000 a month on average. On the 80-20 split, I make about $1,000 a month on average on that deal, right? And now, obviously, as you get into 100 and 200 unit buildings, it could be more. You'd be making $10,000 or $20,000 a month on just a 20% share. But it makes less sense to have that 50-50 split. And I don't know if we were going to talk about it on this, but we chatted about it just before we hit record, that a 3% acquisition fee on a $2 million building, I don't think is egregious. It's $60,000. Just depends on how much work went into it. Yep. And maybe you didn't have a broker in there. Maybe you sourced the deal yourself. All these other things, right? That you help keep the costs low and pays you for your time, right? I mean, a syndicate, I mean, like myself and Dustin, we don't have W-2 jobs, right? So if our investors want us to keep sourcing deals for them and running them, we have to be able to feed our families and live, right? So not saying that one deal needs to support my entire lifestyle, but we do need each deal to kind of support its own basic needs, or be able to hire someone to do that should I need to go get a W-2 job to put food on the table. Yep. So that's where a lot of those fees come from. And if you end up sitting at a $100 million building, I don't think 3% makes sense. Right now you're talking about $3 million acquisition fee. That's more than the broker's going to make. Yeah. You should have I think anywhere on a building from, maybe I'm going to shoot myself in the foot for saying this down the line when we go buy a $100 million building. I was like, wow, 3% sounds great. But if $60,000 to $300,000, depending on the size of the building. Yeah. I do know some people who have taken like $750,000 acquisition fees on very large assets when they have very large teams. I mean, 100-person companies running the full pipeline and acquiring them, and they have in-house maintenance, and they're analyzing staff, and they're flying staff up there to view the buildings. I mean, there are core functions being used that require higher fees, right? Yep. But it's kind of, you get what you pay for.
Yep. And that's I'm glad you brought that up, because that's like, even in instances like that, a lot of times that's not pure profit to the person, right? That's not like they're going to, continue flying on their private jet. That's like going to pay literally the salaries of the team members who are making the deal happen. And especially at those larger sizes, that might be the only deal they do that year. So the vast majority of the so-called, keep the lights on money is going to come from that. So, I mean, this, I think, to kind of round this out, like that focusing on or getting fixated on some sort of percentage is not the only thing. I think focusing on sponsor quality, and then the composition and the reasonableness, if that's a word, of the fees is a much better place if you're evaluating a syndication, or, if this is new to you and you're only ever used to the single family world where, maybe you have one partner and everybody splits it equally, right? So if you got one person, you're splitting it in half. If it's, three people, you're splitting it in thirds. Look at not just the percentage, or the percentage of the split, but everything else around it. I think that's typically where there's more gotchas that are going to happen. Because if you're investing in a $100 million deal and there's a 3% acquisition fee, probably need to be asking some questions about that, because that's a lot. Yeah. That's a whole lot. But at the same time, you've got people, and I don't want to make this an episode about fees, but you've got people that will feel like sponsors should never take any fees. And I realize that it's somewhat self-serving to say this as sitting on the sponsor side, but you do have to keep the lights on, right? And I think as a passive investor, if you didn't have to source a deal yourself, you weren't the one that had to go out and find the deal and negotiate it. And then Adam, one of the things you didn't mention was, okay, for every one $60,000 acquisition fee, how many deals had to be underwritten and looked at and evaluated and offered on, and all this process, and then they fell through, or there was some other offer that got accepted. Like that one deal is the end result of a very, very long funnel with a lot of other work that was done that completely fell through and was effectively unpaid. So if you're a passive investor and you want a sponsor to continue bringing you deals, that's somewhat of like that fee is designed to do that, right? It's designed to keep the lights on so that the person can continue doing those things and provide the best results for the investors.
And we've talked about this before, but it's all about alignment, right? And I think you've got to make sure you feel good about the fees you're paying, no different than hiring any other professional to do something, right? Like if you're hiring a CPA and they're $50,000 a year, I imagine if you keep paying that, you feel pretty good about the services they're doing, right? And if you hire H&R Block for $200 a year, you're probably pretty sure of the services you're getting. I'm not saying the fee directly correlates to the amount of work being done, but the deal's just got to make sense. And I think another thing to note on that is if the acquisition fee is let's say it's 3%, $3 million on a $100 million deal, which I think would be very large. I think that's different if the sponsor takes the $3 million, or if the sponsor leaves the $3 million in the deal as equity and says, this is my equity in the deal, call it sweat equity for putting the whole deal together. I'm not pulling $1 of that out, or maybe $100,000 to run, first year admin stuff, and then it stays, right? Yep. I think that's different, right? Once again, back to alignment.
Yeah. Yeah. And not to go too deep into that, but that's another thing where that can show alignment, where it's like you've got someone that's not doing the sponsor's not doing the deal so that they can collect a cash fee, right? And that's, again, not that that's right or wrong. I think both can be fine, but especially if you've got a sponsor that's in a position that they don't have to take the cash of some sort of acquisition fee. Personally, they can roll that just as their own equity investment essentially into the deal. Then that means that they're not getting any money back out of it until the LPs are, because that money effectively just became a LP investment. So definitely alignment there. Again, that's not right or wrong, but that's another way of evaluating the quality of a deal, as opposed to getting completely fixated on the fact that the sponsor's taking 20%, right? That's just not the thing that matters the most here. Any parting thoughts? All right,
Not
Adam shaking his. If you're audio only, Adam was shaking his head no. So I'll narrate the head shaking. But we appreciate everybody listening. As we said at the top, thank you for doing all the things that we asked to do, and we definitely appreciate you taking some time to like and subscribe on YouTube. Give us a 5-star review on Apple Podcasts, and what is it on Spotify, Adam?
I don't remember. It's like or. I'll figure it out for the next one. For
the 5 people that listen on Spotify, we appreciate you. Just go do the thing that you need to do over there. We appreciate that. But like I said, we appreciate that, and we'll get the message out to as many people as possible, letting the computers know and sharing it with more people. But thank you again so much for listening. We will catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.